Hi everyone. Today we will be discussing the use of derivatives in the airline industry during the pandemic, focusing on Qantas Group as a representative. The Qantas Group mainly apply derivatives to control risk exposures related to interest rate, exchange rate, and fuel price. Credit and liquidity risk are managed with other financial instruments. Our findings suggest that while derivatives hedgings reduce the company's common risk exposures during COVID, the unexpected impact from COVID has also incurred losses to the company due to an overhedged position in forecasted cash flows. I'll be talking about interest rate risk, followed by Yuezhang on foreign exchange risk, Yi Ying on fuel price risk, Claudia on liquidity and credit risk, and Carol will provide a conclusion to our findings, followed with a Q&A discussion from the whole team to end the presentation. Interest rate risk. From the Qantas Group, interest rate risk exposures primarily comes from interest rate sensitivity asset and liabilities principally include debt, leases, and cash. These are predominantly in Australian dollars and US dollars. The group controls this exposure by managing the ratio between fixed and floating rate debts using three main derivatives. First, the interest rate swap, converting fixed or floating payments into the opposite according to needs. Second, the forward rate agreement, where parties will settle the differential between contract and settlement rate. And last, options, the rights to buy or sell an underlying asset for a certain price before an agreed expiration date. As shown in the figure, market interest rates in Australia and the US significantly decreased upon the impact of COVID due to quantitative easing policies. Interest hedging derivatives incurred losses to the company as a result. To mitigate this loss, the group reduced its hedging position on interest rates and moved towards less fixed and more floating debt structure. At the same time, interest rate bearing liabilities increased to 6,693 million from 5,137 million in 2019 due to short-term financing in order to cope with the COVID shock. As at 30th of June 2020, derivative financial instruments relating to debt obligations and future interest payments total to 7 million in liability. In theory, we know that companies with lower operating profit and higher liquid asset will reside on higher fixed rate ratio to protect the company from decreasing interest rates that would lead to future financial constraints. And vice versa, companies with higher operating profit resort to higher floating rate to give them a chance to benefit from the fluctuating market interest rates. Given Qantas's ratio of fixed floating rate on net debt, each period, although still can be improved, we can see that Qantas is putting efforts to overcome this risk, trying to maintain a higher fixed rate and lower operating margins, except in 2021. Last but not least, Qantas's financial statement also provides a sensitivity analysis on interest rates, measuring the changes in profit before tax and equity before tax in response to a 100 basis points or 0.01% change in interest rate. Given the extreme changes in interest rate during the pandemic, we can see that Qantas is able to minimize its loss in most of the years. Without the derivatives implemented, Qantas will face a bigger loss.
For the Qantas Group, foreign exchange risk arises from uncertain fluctuations in the fair value of future cash flows, assets and liabilities denominated in a foreign currency other than the Australian dollar due to changes in foreign exchange rates. The 2018 annual report discloses that cross-currency swaps are used to convert long-term foreign currency borrowings to other currencies in which the Qantas Group has forecasted sufficient funding to meet the swap obligations. At the same time, forward exchange contracts are used to match the timing of these cash flows. A portion of the remaining net foreign currency exposures, including foreign currency purchase and disposal of PP&E and capital expenditures, are hedged with FEC and currency options. Foreign exchange risk related to fuel price will be discussed by Yi Ying in the next section. The 2020 annual report states that foreign exchange risk is primarily associated with the US dollar. As shown in Figure 1, COVID shock caused the Australian dollar to depreciate dramatically against the US dollar. This increases the Australian dollar cost of long-term borrowings, capital expenditures, and operating expenditures denominated in the US dollar. The hedging instruments discussed above can mitigate this impact. However, a foreign exchange loss of 46 million still incurred over the 2020 financial year, compared to a gain of 130 million in 2019. On the other hand, COVID shock significantly reduced revenue from international flights. Over-hedged position on revenue incurred losses as a result of depreciating Australian dollar. As at the 30th of June 2020, the carrying amount of hedging instruments related to revenue recorded 1,098 million in liability. In early April 2020, the Qantas Group closed out its overhedged position through to September, which significantly lowered the exposure to further hedging losses in the short term.
Two factors contribute to the risk exposure on future USD fuel costs: the fluctuations in the USD-denominated fuel prices and the currency exchange rate. The Qantas Group uses options and swaps on jet kerosene, gasoil, and crude oil to hedge exposures to the USD price of aviation fuels. The foreign exchange risk in the total fuel cost is separately hedged using foreign exchange contracts and currency options. As shown in the figure, the COVID shock at the end of 2019 significantly reduced the USD-denominated jet fuel and crude oil price. Hedging position on the US dollar-denominated aviation fuel price include a significant loss from the price drop. On the other hand, the hedging position on currency exchange associated with US dollar aviation fuel purchases has made a gain from the depreciation of the Australian dollar. This gain offsets the loss on fuel price hedging. Overall, for the 2020 financial year, the fuel and foreign exchange derivatives totaled $57 million in net liability, a significant reduction in value from the $286 million net asset in 2019.
Regarding liquidity risk, the Qantas Group aims to keep an optimal capital structure, targeting a minimal liquidity level to ensure its ability to meet short-term and long-term obligations. The group used the commercial paper and standby facilities as their hedging strategy to hedge the liquidity risk exposure, but they are not financial derivatives. In terms of credit risk, the Qantas Group has credit default exposure in respect of trade receivable and other financial instruments in the ordinary courses of business. To hedge the credit risk exposure to the trade default counterparties, the group strategy was to rely on the credit rating check for members and counterparties. The group did not use any derivative to hedge the credit risk as well. Qantas should consider that the use of derivatives may allow the group hedging out more liquidity and credit risks.
I will now conclude our findings. For the Qantas Group, upon the impact of COVID, derivatives used to hedge interest rate, exchange rate, and fuel price risk all incurred losses of certain extent to the company. In addition, due to the unexpected significant decrease in flying activity, designation of the overhedged position resulted in 571 million hedge losses immediately recognized in the statement of comprehensive income. To conclude, despite the success of financial derivative in mitigating risks, hedging can also limit the company's potential to profit and even incur losses when facing the unexpected hit like the COVID pandemic.
Now, for this Q&A section, each of us will be reflecting on Qantas's risk management strategies from different risk exposure perspectives.
Looking at the interest rate risk, although Qantas made efforts in utilizing relevant derivatives to suppress this risk, the management can be further improved by a better administration of the fixed to floating rate ratio according to the levels of operating profit generated each year. They can also further offset the risk by buying bonds with different maturities.
Qantas fuel price risk management can further offset the negative impact of COVID-19 on specific fuels. by investing in fuel-focused ETFs that are diversified across multiple assets in the energy sector.
From the credit risk perspective, since the probability of the counterparty default has increased in the pandemic, other than the financial instrument discussed above, to better hedge credit risk, the group can also apply credit default swap or asset-backed securities to hedge the exposure to credit risk.
Qantas does not use derivatives to hedge its liquidity risk. According to research, liquidity options can be used to hedge liquidity risks. Suppose the liquidity of a publicly traded asset is low. Qantas can withdraw their investment at the market price. They can also tailor the options to their specific needs, allowing for more precise risk management and reduces the uncertainty associated with liquidity fluctuations.
The foreign exchange market is very volatile. As an international corporation, almost all aspects of operation in the foreign market is associated with currency exchange. To maximize gains, the management of exchange rate hedging needs to be closely following its business strategies, such as fuel purchases and flight revenue forecasts. In case of COVID, the quicker the company can act to de-designate its overhedged position, the more losses can be mitigated. This concludes our presentation. Thank you for listening.